Okay, let's unpack this. Welcome to TalkTickers.
Hey there.
Our job is to take you straight inside the recent earnings calls that matter, cut through the jargon, and, figure out what's really going on.
That's the plan.
Today, we're diving deep into the fiscal second quarter 2025 earnings call from Keysight Technologies.
Yep, Keysight. We're going to break down the key numbers, hear what management said, and look at what it signals for Keysight and, well, the markets they operate in.
Sounds good. This was a pretty interesting quarter, wasn't it? It seemed to confirm some trends we've been watching.
It did. Yeah, it definitely provided more detail on key drivers. So let's just get right into the headline numbers for the quarter.
Absolutely. So the big picture for Q2 fiscal 25 looks pretty solid. They reported revenue of $1.306 billion.
Right. And importantly, that came in above the high end of their own guidance range.
Which is always a good sign.
Yeah, definitely. At $1.306 billion represents a 7% increase year over year on a reported basis. And it's 8% if you look at it on a core basis, excluding currency and M&A stuff.
Got it. And orders.
Orders were also strong this quarter, came in at $1.316 billion. So that's up 8% year over year and a healthy 4% jump sequentially from Q1.
Okay, solid top line, solid orders, and the bottom line followed suit.
It did. Earnings per share landed at $1.70. That also beat the high end of their guidance.
Okay, so overall, a strong beat.
What's really notable here, I think, is that this marks the second consecutive quarter where Keysight has reported year-over-year revenue growth.
Right, that's key. Part of that recovery story playing out.
Exactly. Primarily driven by continued momentum in their Communication Solutions Group, that's CSG, and importantly, a return to growth in the Electronic Industrial Solutions Group, EISG.
Okay, so we've got the numbers, they beat expectations, clear trend of recovery starting. Where specifically did that growth come from? Let's break down the segments.
Sure. Leading the way, as it often does, is the Communication Solutions Group, CSG. Their revenue was $913 million in Q2.
$913 million. And
strong growth.
Strong growth. Up 9% on both reported and core measures. Pretty consistent there. And within CSG, you've got two main pieces, right? Commercial comms.
Yep. Commercial communications, which includes their big WLINE business think data centers, networks that generated $612 million.
Okay.
Also up a healthy 9%.
Yeah.
Showing sustained strength, particularly in WLINE, like you said. And interestingly, a return to growth in wireless too.
And the other side, ADG.
The other part is aerospace, defense, and government, or ADG. Yep. That segment hit $301 million, also growing 9% year over year. So, both sides of CSG showing really solid momentum.
And profitability looked good too.
Correct. CSG delivered a 67% gross margin and a 26% operating margin this quarter. Strong numbers.
Okay. Now moving over to EISG, the Electronic Industrial Solutions Group. What was the story there?
So EISG brought in $393 million in revenue. That was an increase of 5% year over year.
5%. So growth, but maybe not quite as explosive as CSG this quarter.
Right. The growth here was really fueled by strength they saw in semiconductor and general electronics. Those areas more than offset declines they saw in the automotive and energy sectors within EISG.
Okay, so a bit of a mixed bag within EISG, but positive overall. Margins.
Margins in EISG were 59% gross and 23% operating margin. So, you can see the difference compared to CSG, which is pretty typical based on the product mix in each segment.
All right, so we see where the growth is happening. Now let's dig into the why. This is where it gets really interesting, the market dynamics, the big trends they talked about. AI, obviously, still a huge theme.
Absolutely. Huge. Management clearly views AI as a major long-term secular trend. They sound very confident about it.
They seem to feel it fits their strategy well.
Yeah, they see a clear multi-year roadmap ahead, and they feel it's a strong fit with Keysight's focus. They're seeing contributions, across the AI ecosystem, memory, compute, all the way through networking.
And it's not just about the chips, right? It's the whole infrastructure challenge.
Exactly. They mentioned the industry is actively tackling these complex challenges of scaling up and scaling out the digital infrastructure needed for these massive AI workloads.
Yeah.
How do you connect everything efficiently?
Right, which plays right into their WLINE business.
Totally. Their WLINE business, deeply involved in that digital infrastructure, saw strong performance. It actually grew double digits in the first half of their fiscal year.
Double digits, wow.
And they noted the rapid increase in AI workloads is actually causing customers to pull in their timelines for deploying and upgrading their infrastructure. Things are moving faster.
And Keysight's helping with that speed.
Seems like it. They highlighted design wins in software emulation tools. These help companies basically find and fix performance bottlenecks. specifically in these new kinds of AI data centers.
Okay, so sticking with WLINE orders were strong there too.
Oh, yeah. Orders in WLINE grew double digits this quarter as well, reinforces that demand signal.
And that's tied to?
Directly tied to the ongoing data center infrastructure expansion. Think 400 gig, 800 gig Ethernet deployments. And also the R&D work already happening on the next waves, 1.6 terabit, 3.2 terabit technologies, both electrical and optical. Big stuff.
Yeah, those speeds are mind-boggling. And they're actually demonstrating this stuff now, right? Like at OFC.
They are. They demonstrated the industry's first solution for 448 gigabits per lane optical transmission at the OFC conference recently.
Per lane. So that's like the individual data path within the fiber. Getting more speed per lane is critical for those feature networks.
Exactly. It's a key building block for 1.6T, 3.2T. And their strategic focus in WLINE, while it's still heavily R&D oriented, they talked about maybe a 7-30 split, R&D versus manufacturing solutions.
Right.
They're now benefiting as customers move from that R&D phase into the manufacturing ramp for the current generation tech.
And they're getting new customers too.
Seems so. Customer base expanding. And the increasing technical complexity, these new standards, new architectures, that just drives demand for Keysight's sophisticated R&D and test solutions.
Like the hybrid electrical optical stuff needed inside data centers now?
Perfect example. That complexity is good for their business model.
Okay. What about wireless? You mentioned it returned to growth within CSG.
Yeah, wireless. Orders did grow in Q2, and they characterized the overall business as stable. R&D activity seems steady. They're focused on areas like 5G advanced, early research into 6G, and non-terrestrial networks.
Non-terrestrial, so satellites, drones.
Exactly. Think satellite or drone communication systems. Now, while the smartphone supply chain stuff is generally stable, they did note some softness in related business, especially coming out of China.
Okay.
But R&D for radio access networks, the infrastructure for mobile communication that continues to grow. And they also mentioned leveraging their newer digital twin and system emulation capabilities.
All of the simulation tools again?
Right. Using those to expand engagements in the ADG space, especially for those non-terrestrial applications we just talked about.
Speaking of ADG, aerospace, defense, government, continued strength there.
It did. That segment continued its strong performance. Orders grew this quarter. They saw particular strength in the U.S. and Europe.
What's driving that?
Key drivers seem to be government investments in spectrum operations, space applications, things like that.
Even with the U.S. budget situation, the continuing resolution stuff.
Yeah, even with the U.S. operating under continuing resolution, which can limit the start of new programs, they said the overall demand and the pipeline for ADG remain robust. They pointed to prime contractor backlogs reportedly being at record levels.
So the primes have work, and Keysight helps them execute it.
Pretty much.
Yeah.
And globally, defense modernization is clearly a top priority. You see budget proposals showing increases not just in the U.S., but also Europe, Asia.
And Keysight's angle?
They see themselves well-positioned as a trusted partner, providing those advanced test capabilities needed to simulate complex electronic threats in a lab environment. That's critical for modern defense systems.
They mentioned some specific wins, didn't they?
They did. Highlighted a significant deal with the European Defense Agency for antenna radar modernization, a NATO contract for radar and electronic support measures modernization, and being selected by the U.S. Army to help validate zero trust security on their unified network.
Interesting. Zero trust is a big buzzword.
It is. And they noted this ADG business is generally a bit easier to forecast long-term because, well, the budget trends tend to be clearer than in some commercial markets.
Makes sense. Okay, let's shift back to EISG. The semiconductor business, you said it returned to growth.
Yes, finally. Return to growth this quarter after 6 consecutive quarters of decline. So that's a positive sign. Demand for their wafer test solutions from the large foundry and IDM customers is strong.
What's driving the semi-rebound for them?
It's largely investment at the leading-edge process nodes, the most advanced chip manufacturing, and also the rapid growth in high-bandwidth applications, which, again, loops back heavily to AI demand.
Okay. And they mentioned silicon photonics and co-packaged optics, CPO.
Yep. They're seeing customer engagements for silicon photonics and CPO accelerating. These are technologies where optics are integrated much closer to the processor chip itself.
Why is that important?
It's becoming essential to overcome the limits, latency, bandwidth, power consumption that current approaches hit in these really high-performance AI data centers.
And that changes the testing needs.
Big time. With CPO adoption, test demand moves closer to the semiconductor level itself. It requires combined optical, electrical, probing, and metrology capabilities. Basically, highly complex, integrated testing.
And Keysight saw this coming.
Seems like it. They mentioned they made investments in these specific capabilities about 18 months ago and are now benefiting from that foresight as the industry starts adopting these new technologies.
Good timing. Okay, what about automotive within EISG? You said that was down.
Yeah, in automotive, both orders and revenue were down in Q2. But they did say the business is largely stabilized.
So not falling off a cliff, just soft.
Right. They're seeing steady engagements with OEM customers, focused on testing related to this software-defined vehicle trend, cybersecurity in cars, radar scene emulation for autonomous systems, and developing ADAS chipsets.
Anything notable there?
They mentioned a wind-securing design and test work for home energy management systems with a major automotive OEM.
Oh, interesting. So beyond just the car itself.
Exactly. Suggests their capabilities are relevant in that broader ecosystem. But like other areas, the China automotive market was specifically noted as weak.
Okay. And the last piece of EISG, General Electronics.
General Electronics GE orders actually grew there for the third consecutive quarter. So some steady momentum, though maybe at a slightly lower rate than before.
What's working in GE?
Growth in applications like multi-industrial, diverse manufacturing needs, and also medtech R&D and manufacturing helped offset some headwinds.
And the headwinds were?
Things like a contraction in U.S. education funding and just a normalization in distribution channels after some previous stocking. But areas like digital health and general research remain pretty durable drivers.
And they brought up something interesting about manufacturing footprints.
Yeah, this is interesting. Driven by ongoing tariff concerns, they're having conversations with customers about diversifying their manufacturing footprint. Setting up manufacturing outside traditional locations, maybe outside China, for instance.
And Keysight sees that as an opportunity.
Right, because new manufacturing sites require new test and measurement solutions. They mentioned this is a conversation that could translate into opportunities playing out over the next, say, 90 to 180 days.
Okay, something to watch. And like auto and wireless, China GE was weak too?
Yep, noted as weak.
Okay, so that covers the main hardware segments. But their software and services business is becoming a bigger part of the story, isn't it?
Increasingly important, yeah. It made up about 36% of total revenue this quarter. And within that, 28% was annual recurring revenue, or ARR.
36% total, 28% recurring. That's significant.
It really is. That recurring revenue stream is key to the company's resilience. It provides a more stable base, especially when things are uncertain elsewhere. It's definitely a strategic focus area for them to grow this part of the business.
And they're seeing growth there.
They specifically highlighted double-digit growth in their simulation business. That's been boosted by M&A, like the ESI acquisition. And they also see potential for further growth from anticipated acquisitions related to that larger Synopsys and Ansys transaction. It sort of implies Keysight might acquire some pieces that have to be divested from that big deal.
Ah, interesting. So more M&A potentially boosting software.
Could be. Growing software and recurring revenue, it increases that predictable base, and it also lets Keysight engage earlier in the customer's design cycle. Fits right into their R&D focus strategy.
Makes sense. Does the percentage mix shift much?
Well, they did say the percentage of total revenue from software might dip slightly in the short term if hardware recovers really strongly, but the long-term goal is definitely to drive software to a higher percentage of the total mix.
Okay. Looking at the financials beyond revenue and profit. Cash position, balance sheet.
Looks strong. Keysight ended the quarter with $3.184 million in cash on the balance sheet.
Nice cushion.
Yeah. And they generated impressive cash flow from operations, $484 million. Free cash flow was $457 million.
Strong cash generation. What helped that?
Partly improvements in working capital. They reduced inventory days by about 10 and DSO days sales outstanding by about 3 days. And they also benefited from lower tax payments compared to last year.
Got it. Any updates on acquisitions? You mentioned potential deals, but what about ones already announced, like Spirent?
Yeah, they talked about Spirent. First, they issued $750 million in senior notes back in April. Said it was for general corporate purposes, but potentially including funding that Spirent acquisition.
Okay. And the deal itself?
The Spirent deal got clearance from the UK's Competition Authority, the CMA, back in March. It's progressing through other regulatory reviews, and they expect it to close in their fiscal Q3, so pretty soon.
Any financial wrinkles there?
They noted a roughly $16 million gain related to a hedging contract they had for the Spirent purchase price. That was recognized in Q2, so it gave a small boost to the reported results.
Okay. And the other potential deals linked to Synopsys Ansys.
Right, the Optical Solutions Group and Power Artist acquisitions. They basically said those are anticipated to close shortly after the main Synopsys transaction is completed, which, like we said, strongly implies these are divestitures Keysight is set to pick up.
Okay. And capital allocation, returning cash to shareholders.
Priorities haven't changed there, they said. Still focused on investing for the long term in the business itself, while also returning capital to shareholders.
What did they do in Q2?
In Q2, they repurchased 1.042 million shares for $150 million. Works out to an average price of around $144 per share.
And bigger picture on buybacks.
Looking back, they mentioned they've returned over $1.7 billion to shareholders via share repurchases over just the last 12 quarters. It's about 50% of their free cash flow during that period. So pretty consistent return program.
Okay, let's put all of this into context now, especially for investors listening. A really key takeaway from the call was that Keysight raised their guidance for the full year.
That is notable, especially, as you said, when they also acknowledged the dynamic and uncertain macroeconomic environment out there.
Right. They specifically stated they have not seen material adverse effects on demand from tariffs yet.
Which is interesting timing, given all the tariff talk lately.
Exactly. Their confidence to raise guidance seems, based on that strong Q2 performance we discussed, their robust pipeline of opportunities, a healthy backlog, $2.44 billion going into Q3, and also the expectation of a normal seasonal uplift in Q4. They still think Q4 will be their strongest quarter.
Yeah, what's the new outlook?
They now expect fiscal year 25 revenue growth to be right at the midpoint of their long-term target range of 5-7%.
Okay, so firmly within target.
And importantly, they expect annual EPS growth to be slightly above their long-term target of 10%.
Slightly above 10% EPS growth. That's a confident signal.
Yeah. They characterize the year overall as following a sort of slow, gradual recovery trajectory. Not a sudden snapback, but steady improvement.
Okay. Now let's talk more about that tariff situation they mentioned. They actually went into quite a bit of detail, which was helpful.
Yeah, they did. They emphasized having a diversified global supply chain with minimal direct manufacturing exposure in China.
And they have a plan.
A multi-pronged approach, they called it, involving adjusting their manufacturing footprint, sourcing strategies, pricing actions, and cost controls.
What's the estimated impact?
Based on actions they've already taken, they estimate their gross annual exposure to tariffs is somewhere between $75 million and $100 million.
Okay, that's the gross number.
Right, and they are actively working to reduce this further and offset the remaining impact through those mitigation efforts.
Got it. Now, the timing of the impact is important here.
Very important. A key point is that their pricing actions related to tariffs were not applied to their pre-existing backlog.
Okay. So orders taken before the new tariffs don't get the price hike.
Exactly. Because of this, the most significant impact of the tariffs is expected right now in their current quarter, Q3. They project the Q3 impact will be more than double the $7 million expense they saw in Q2.
Okay, so Q3 takes the biggest hit. What was the Q2 impact again?
That $7 million tariff expense in Q2 caused about a 60 basis point unfavorable impact on both gross and operating margins. And it reduced EPS by about 4 cents, 4 cents.
Okay. But they expect to fix this.
They expect to achieve full mitigation of the tariff impact by the end of this fiscal year. So by Q4, presumably.
And where are these tariffs coming from? Is it all U.S., China?
Interestingly, no. They said their exposure to tariffs, specifically between the U.S. and China in both directions, is actually less than 10% of their total tariff exposure.
Less than 10%. Huh.
So it's broader than just that relationship.
Seems so. They're using a 10% tariff rate as their base case for planning right now, but they also stated they are prepared with operational realignments and strategies to respond even if tariff rates go higher.
Okay, they're scenario planning. What does this do to their operating margin outlook for the full year?
Good question. Historically, they target about a 40% incremental operating margin on 5% plus growth. For every extra dollar of revenue, 40 cents drops to operating profit.
Right, that's been their model. But the tariffs are new, significant short-term costs, and those are temporarily impacting their ability to deliver that historical incremental margin profile.
So margins won't expand as much as usual with the growth.
Correct. Because of the tariff headwind, they expect their fiscal year 25 operating margin to be relatively flattish compared to fiscal year 24, despite the revenue growth.
Flattish margins year over year due to tariffs. Got it.
But overall, management kept coming back to their resilience of their business model.
Yeah, you heard that theme a lot. underpinned by a flexible cost structure, an agile supply chain, and operational capabilities that allow them to adapt to these external dynamics, like the macro uncertainty and these tariffs.
Okay, so now for our favorite part, disclaimer time.
Deep breaths, everyone.
This is not financial advice. What follows is purely a thought experiment, an outrageous but plausible idea based solely on the commentary we just heard from the Keysight call, purely for illustrative purposes. Don't trade on this.
Please don't. Okay, so thinking about those specific points management made, like their supply chain agility, right? And those conversations they mentioned having with customers about manufacturing footprint diversification. Especially that 90 to 180-day timeline they threw out there.
Right. Here's a wild idea, playing off just that. Based purely on this call, you could theoretically consider initiating a long position in Keysight.
Okay, long Keysight.
And to make it really interesting, pair it with a short position in a hypothetical global manufacturing company, maybe one whose call we listened to recently that has significant acknowledged China-based production or heavy component sourcing exposure.
And maybe hasn't talked as much about agility or diversification plans.
Exactly. A company that hasn't demonstrated or discussed Keysight's level of supply chain agility or those proactive customer conversations about moving production.
Okay, so the core thesis here, based just on this call, is betting that Keysight's stated agility and those specific customer diversification discussions could create potential tailwinds for them over the next, say, 3 to 6 months.
Aligning with that 90, 180-day timeline they mentioned.
And that these potential tailwinds might not yet be fully reflected in Keysight's stock price compared to a peer who seems, on the surface, more exposed and maybe less prepared to navigate this tariff landscape.
The outrageous part is definitely putting that specific time frame, 90, 180 days, on a super complex global supply chain shift based primarily on, brief commentary from one company's earnings call.
Yeah, that's a leap.
But it's plausible because Keysight is explicitly having these conversations and claims to be strategically positioned to potentially benefit as customers look to diversify manufacturing locations. It's basically a bet on relative resilience and a specific catalyst time frame mentioned on the call.
A highly speculative bet based solely on call commentary.
Extremely. Not financial advice. Okay, so let's quickly recap the core takeaways from Keysight's fiscal Q2 call before we wrap up.
All right. Strong beat on both revenue and EPS. That's number one. Marked their second consecutive quarter of year-over-year growth.
They raised their full-year outlook, showing confidence despite acknowledging the macro uncertainty in those tariff headwinds we just discussed.
And that confidence seems really driven by the strength they're seeing in key secular trends like AI, the continued stability and growth in ADG, and, importantly, that clear return to growth in the semiconductor market.
Plus, they laid out a pretty detailed plan for mitigating the impact of tariffs, expecting full offset by the end of the fiscal year, even though they expect the headwind to be most significant right now in Q3.
Lots to digest there.
Definitely. And again, please remember, this discussion is purely based on the company's earnings call commentary and is absolutely, positively not financial advice.
So maybe a final thought for you, the listener, to consider after this deep dive. Keysight provided quite a detailed look into how they're managing tariff impacts and how they see customer conversations around manufacturing footprint diversification playing out.
Right, that 90, 180-day comment really stood out.
Yeah. So how does that level of detail and that specific time frame they mentioned compare to what you might be hearing from other global industrial or technology companies? Companies with similar global supply chains facing similar pressures.
Yeah, it really makes you wonder which companies are truly prepared, or at least communicating preparedness to adapt to these shifting global trade dynamics and what that might mean for their relative positioning moving forward. Something to think about.